Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Hello and welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today I'm joined by Bipan Rai, Head of ETF Strategy at BMO Global Asset Management, and Chris Krueger, Managing Director from TD Cowen's Washington Research Group. And this week, we obviously have all eyes on Washington with the inauguration of Trump. And while he did stop short of imposing the proposed 25% tariffs on Canada and Mexico day one, he left a little doubt that these are coming, and he's putting America first, so to speak. So today we're going to get both Chris and Bipan's insights around this and how it'll affect Canadians and much, much more. Before we get started, a quick reminder, we're not providing investment advice or recommendations. Today is all about information and education for Canadian do-it-yourself investors. Chris and Bipan, thank you very much for joining me today to record on what I expect is a very busy week for you both. Thanks for being here.
Great to be with you all.
Pleasure to be here, Erin.
Thanks for joining us. Chris, let's kick off our discussion today. I'd love to get a broad overview of sort of what we know as it stands today when it comes to tariffs. What's Trump's objective with these tariffs? And what do we know in terms of potential timing and sectors he's going to be targeting?
Yeah, well, I mean, it's unfortunately, clarity remains in short supply. We got a wave of executive orders on the evening of January 20th. The only real surprise in those was a lack of specifics on the tariffy front. Tariff policy was essentially punted to committees with a report deadline of April 1 by the Commerce Secretary. If it had ended there, I think most north and south of the border would have, exhaled. But we had some ad hoc press comments where Trump really kind of threw some sand into the policy gears. Trump mentioned a 25% tariff on both Canada and Mexico. On February 1st, also suggested China could get 100% tariffs if the U.S. doesn't get 50% ownership in any TikTok divestiture. So February 1st is next Saturday. The only really way to do this in such a compressed time frame would be to trigger the IEEPA statute. That's the International Economic Emergency Powers Act. If that were to happen, we presume he would have to declare some type of economic emergency really by Wednesday or Thursday of next week to hit that effective date. So it is possible. I think the better date to soft circle would be April 1. You also still have the confirmation process ongoing with a number of cabinet officials. The real, issue matrix here, though, remains the bilateral goods deficit. That is the primary scorecard for President Trump.
All right, very good. And can Congress put pressure on Trump to sort of tone this down on the tariff fronts, or what's the most likely path here?
Not really. I mean, the Congress ceded away pretty much, all of these unilateral tariff powers to the office of president, starting in the 30s, but then really escalating through the 60s and 70s. So, Congress can issue their own tariffs, but via IEEPA, via the 74 Trade Act, the 62 Trade Act, the Congress has a lot of unilateral power here. The big question to watch on a go forward will be if the Congress decides to pass its own tariffs that then would have to be signed by President Trump, but they could use those to offset any tax extensions in the reconciliation process.
All right. And can you talk a bit about his priorities when it comes to these tariffs? He seems to be blanketing them across the world here, but is trade with Canada as high up on the list as Mexico and China, let's say?
In early November, I wouldn't have said yes, but it sure seems like it is now. I think the primary, the primary window, though, in which to view these policies remains the bilateral goods deficit. And Trump really sees the world black and white through that prism. So countries that carry a goods surplus, probably are a lower risk for tariff, whether that's Australia, Brazil, the United Kingdom. But we also have the USMCA review process underway. So, again, unfortunately, clarity is in short supply.
And Bipan, let's discuss Canada. How do you see this really impacting the economy here?
Thanks, Erin. And again, needless to say, the implications here are huge potentially. I mean, trade accounts for close to two-thirds of the Canadian GDP, and over 3 million jobs in Canada are tied to the export sector here. And remember, the U.S. is our largest trade partner. In fact, it's the largest bilateral trade relationship in the world, with upwards of 920 billion in total goods and services trade. So again, tariffs and the impact from tariffs do matter. But Canada can retaliate in ways that will put pressure on the U.S. But make no mistake, over the long run, we really have a different threshold. Or at least the U.S. has a far different threshold for pain than we do here. We are the junior partner in the relationship, and as such, a prolonged tariff or trade conflict potentially means that the Bank of Canada will have to get active again when it comes to rate cuts, because it does have implications for the long-term growth trajectory and where the equilibrium level of interest rates could end up here in Canada.
What do you see as the retaliation playbook? We've been here before. Were there approaches that worked in 2018 and 19? And how do you really see this potential retaliation impacting US businesses?
Right. So again, as I mentioned earlier, I mean, Canada's not going to win a long, drawn-out trade war with the U.S., but it does have some leverage to utilize. And I mean, we could go back to the 2018 experience to see what that looks like. And again, lost amidst the hoopla of this conflict are some basic truths, and that is that 33 U.S. states count on Canada as their largest export partner. Republicans also hold a very slim majority in both chambers of Congress. So that means, if we look at sort of the retaliatory playbook for Canada, there's really two. It seems to be focusing around a two-pronged sort of approach. The first one will be targeted tariffs, potentially over broad tariffs. So again, in the U.S., I mean, we've heard basically about broad tariffs, and certainly Trump mentioned that in his impromptu, off-the-cuff comments to the press on inauguration night. But again, that what the targeted approach means is just looking at implementing tariffs on states or sectors that really rely heavily on exports to Canada, and in turn, potentially that also, extending into maybe some pressure being put on Trump by his own inner circle or maybe some members of Congress. Again, that could mean that we're looking at sort of like this MacGyver-esque shopping list of items that are tariffed by Canada as part of the retaliatory playbook. The other item, and a little bit more contentious here north of the border, is the possibility of export taxes, right? And that includes most notably on a sector like crude oil. And again, if we look at the goods trade between Canada and the U.S., yes, Canada does run a modest surplus, but if you strip out energy exports to the U.S., that actually turns into a deficit. So again, the thing to remember about export taxes are that these differ from tariffs primarily because they're imposed on goods leaving the customs area instead of entering it. And in theory, this should lead to a larger discrepancy between foreign and domestic prices. For a smaller country in the trade relationship, i.e. Canada, I mean, that only works if, again, you target goods that are indispensable for other countries. So not just energy exports, but potentially uranium as well. And remember, for U.S. businesses, in particular in the energy sector, U.S. refineries are designed to process heavier grades of crude, akin to the sort that Canadians export, or at least the Canadian energy sector exports to the U.S. And that's primarily because it's cheaper to import heavier grade crude from Canada than it is to spending billions building up the infrastructure to support the lighter, sweeter crude that the U.S. produces. So again, that's primarily the prism, that I'm looking at when it comes to the retaliatory playbook, and also how it potentially impacts businesses as well in the U.S.
Great, very interesting. And Chris, curious to have your thoughts around how the implementation of these tariffs is going to impact other allies like the UK and Europe, for example. What does this mean for relationships over the long term on those fronts?
Yeah, it's again, it's maybe to use Bippin's line, the MacGyver playbook here. I mean, I think every country is a little bit different in that whether it's defense spending, whether it's um, and the bilateral goods deficit would kind of keep coming back to that. the Europeans are probably, when you look at that list of the bilateral goods surplus versus deficit, right? It's China, Canada, Mexico, Vietnam, Europe. We know Europe also animates President Trump. We saw that in the first administration, if you recall, coming out of the 301 investigation into China. There was a plan for the second term to focus on European autos and European auto parts using Section 232, which is what was the impetus for the steel and aluminum tariffs as well. So we haven't really yet, I think, gotten into trade policy. Most of the tariff threats thus far haven't dealt with the bilateral goods deficit at all. They've dealt with immigration flows. They've dealt with fentanyl. They've dealt on the dollar reserve currency. So I think April 1, when that report is due, that's probably when we start to get more clarity on blanket tariffs, targeted tariffs, tariff rates, and potential country carve-outs.
Bipan, do you have anything to add in terms of impact to China under this?
Certainly. And again, if we're talking about important trade partners for the United States, traditionally it's been Mexico, Canada, and of course China. And again, remember that since Trump's first term, China's done a fairly good job of diversifying away from the U.S. market, and I think that's going to be something to remember if we, as expected, see a ratcheting up of trade tensions between the two countries. In particular, China's done a good job sort of reorienting towards emerging markets where growth has been positive, and where geopolitical interests are aligned. And a figure that I've seen floating around is that U.S. demand for Chinese goods, it now just accounts for about 2.8% of China's total output. So again, entering into this trade conflict, I would say China's in a little bit better of a position relative to where we were during Trump's first term, and as such, a tariff as high as 60% on Chinese imports probably doesn't do as much damage to the Chinese economy in general. And keep in mind also that China still manages its exchange rate. So if things can get really rough, there is that option to revalue the renminbi lower. That's not the preferred path that they would most likely choose to follow. Again, that does have a powerful signal impact, and it really does indicate that maybe they're maybe not making as much progress towards that consumption and investment model, and instead relying on the old tried, tested, true export model. So that's why I don't think that's the primary conduit for them to respond. And also remember that China does have some leverage to utilize here, given that it dominates production and refining of key materials that are a lot of industry in the developed world tends to rely on. A clear example of that is rare earth minerals, where it does have near 40% of the world's rare earth reserves and controls up to 70% of the global supply. So again, there are some outs for China during this trade conflict, this looming trade conflict, I should say, relative to Trump's first term. And, with respect to China's own issues, we would argue that it has more to do with those that are domestic, namely the lack of fiscal stimulus to prop up consumption. Obviously, the demographic issues tie into that as well, and also the deleveraging we're seeing happen at the sub-sovereign sector level. Those are the key considerations, and I don't think the trade war really impacts those materially.
Okay, great. And Chris, I'd be remiss if I didn't ask about Greenland. Is he really serious about annexing Greenland? What's the end objective here?
Yes, I'm not sure. Yeah, and I think there was probably going to be broad congressional support for this. When you think about how the United States is composed, there are really three areas here. You have the states, then you have what are called territories, areas like Puerto Rico, the Virgin Islands, and others. And then you have what are called the compacts of free association, largely dating back to World War II and then the late 70s. These are entities like Micronesia and the Marshall Islands. Right now, Greenland is under a protectorate from Denmark. They do have local elections in April. Should Greenland declare independence from Denmark in April, they'll lose about $550 million in block grants from Denmark. That composes more than half of their budget. as the thinking goes, entering into some type of compact of free association, which would then you would have a referendum in Greenland should they vote like the people of Micronesia and the Marshall Islands to enter into a compact of free association with the U.S. The Congress would then have to pass that and then appropriate dollars as such. But I think unlike the comments about Canada as a 51st state and sort of trolling the Prime Minister Trudeau, Greenland does, I think, have a policy map going forward, but it does begin with a vote by the people of Greenland.
Okay, great. Interesting. With so many unknowns, Bipan, let's get into and bring it back to ETFs. Since we're on ETF Market Insights, what are some ideas around how investors can mitigate the risk of some of this expected volatility going forward?
Right. So, and I hope that our viewers are really internalizing the fact that yes, we're getting Trump again in his second term, but the macroeconomic backdrop is very different than the first term. I mean, you don't have interest rates that are close to zero. In fact, you have interest rates that are now offering yields that are higher than those earning yields being offered by the S&P 500. So, what I'm trying to say is that the potential, or at least the proximity towards a significant degree of market volatility, is there. So, in our minds, it does make sense to potentially take some risk off the table and maybe get a little bit more defensive going forward. And also, instead of looking towards capital growth, maybe have an eye on harvesting income. We think those are two very defensible strategies going into this year, and a couple of ETFs that we are tracking fairly closely, and we will be looking to add to our own portfolios is, of course, our BMO US Equity Buffer Hedge to CAD ETF, or the ZJAN. Again, if we're heading into this environment of significant amount of chop, it does make sense to potentially protect that downside risk via the buffer ETF. And keep in mind, you do get that 15% protection, over the coming 12 months, and that certainly does look attractive in an environment like this, where we really do see, a lot of headwinds to the view that we're going to see double-digit gains in the U.S. Market for this year. Or another income play that we potentially could get behind is the ZWH, which is, of course, the BMO US High Dividend Covered Call ETF. And again, that's a strategy that's particularly focused on harvesting income, and we think that it could look reasonably attractive in an environment where we do see a significant amount of market chop.
Very good. Thanks, Bipan. The buffers seem to be coming up week after week on these discussions. Thank you so much, Chris and Bipan, for taking the time to join me today. Really exciting time in the U.S. and the markets, and it's great to have your insights and guidance around what's going on. So thanks again for joining me today.
Thanks,
That
Erin.
was great. Hope to do it again.
Before I close out, I want to let our viewers know that we are hosting a Reddit AMA with Bipan. If you have questions for him, the details are on screen here. So please, if you're a Redditor, check it out and drop us a question. We will be back next week, and I'm looking forward to chatting with Jessica Morehouse, host of the More Money podcast and author of Everything But Money. We'll be talking about the psychology of money and her thoughts around the rise and popularity of ETFs. That's all for today. We'll see you next week. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.